Good morning, everyone. I think we're ready to start. My name is David Graham, and I'm the Executive Director at the British Chamber of Commerce in Hong Kong. And it's my pleasure to introduce today's British Chamber webinar entitled Updated IPO Guidance Letter, What You Need to Know, a subject dear to my heart given my previous role at the Hong Kong Stock Exchange. Let me introduce the panelists. First, Julia Charlton. Julia is the founding and managing partner of Charltons, a boutique corporate finance Hong Kong law firm. She practices in the field of corporate finance, including M&A, private equity, securities, virtual assets, and funds. And she advises sponsors and issuers on the HKEX listing rules of both the main board and GEM. Julia is currently a member of the Listing Review Committee, a member of the SFC Takeovers Panel, and the Takeovers Appeal Panel, a senior fellow of the HKSI, and a member of the Company Law Committee of the Hong Kong Law Society. Next, Pat Wu. Pat is a partner of strategic development at KPMG and oversees corporate social responsibility, as well as being a core member of the KPMG China Steering Committee on Climate Change and Sustainability. He's also a member of the KPMG Global Climate Change Network, and he's also the chair of the British Chamber's Energy and Environmental Committee. Pat currently serves on the United Nations Economic and Social Commission for Asia Pacific on their Sustainable Business Network Task Force on Banking and Finance. And then finally, Catherine Ng, who is your moderator as well as a panelist. Catherine is the Chief Operating Officer and Head of Policy and Secretariat Services Department in the Listing Division of the Stock Exchange. She joined the Hong Kong Stock Exchange in 2013. Prior to that, she'd served as political assistant to the Secretary for Financial Services and the Treasury of the Hong Kong government, worked in an international investment bank and an international law firm in Hong Kong and London. In addition, she's been the chairman of the Hong Kong Securities and Investment Institute since December 2018. She's an advisor to Our Hong Kong Foundation, a director of the Worldwide Fund for Nature Hong Kong, a fellow of the Aspen Institute, and a member of the Hong Kong Academy of Finance. Before I hand over to Catherine, let me just talk a little bit about the webinar itself and the subject matter. Whilst COVID-19 has brought about many unfortunate circumstances, it has also underscored the importance of good corporate and environmental and social governance, known as ESG. Leading investment strategies are now strongly associated with good corporate governance and ESG, which in turn are being widely supported by regulators, indices, and exchanges. In July of this year, the Hong Kong Exchange updated their IPO guidance letter to highlight the importance of corporate governance and ESG mechanisms being built into their listing processes. In December, they released a deep dive brochure to disseminate information on the topic. The Chamber has brought together a panel, which I've just introduced, featuring a selection of the expert authors behind the brochure. These panelists will share their practical insights into the listings application process and how it relates to corporate governance and ESG. The discussion will include designing and implementing effective corporate governance and best practices within ESG. And with that, I'll hand over to Catherine.
Thank you, David. So I'll just say a few words about the IPO guide, and then I will turn over to Pat and Julia to give you more insights about on kind of IPO guidance and how to specify it. I think the starting point where Hong Kong X is coming from is that CG ESG is no longer an afterthought. You know, we've put a lot of effort on listed issuers and how they should disclose, measure, and manage their ESG and CG risks. And it's come to our attention. We've kind of brought it forward. We want to let the market know that, you know, CG and ESG is not something you just embark on towards the end of your first financial year. It's not something that, you know, after a year of running your company, you write the policy or thinking about what the policy is. It needs to be there at the get-go. So whether it's my team giving guidance on what the policies that need to be in place, if you have material risks on ESG and CG should look like in the IPO prospectuses, my counterpart and the teams in IPO vetting, they've also, I think, the investment bankers would have noticed, and issuers as well, that we are asking a lot more questions on ESG risk, whether it's environmental or social, as well as board diversity. If a company has a single gender board, how do they think they can satisfy their diversity requirements? That is the thinking that went behind the guidance note 8616. Those who are in the IPO market will know that this is the guidance that sets out all the disclosure requirements and things which issuers need to consider when they're writing their IPO prospectuses. So the guidance letter set out what material information are expected on applicants on environmental policies, details of the process used to identify, evaluate, and manage significant ESG risks. So we put together the guidance letter. We got a lot of feedback from the market that, you know, they want to know how it works in practice. I mean, IPO applicants are keen. They're keen to satisfy the requirements. So they've asked us how they can, in practice, put together meaningful policies and meaningful disclosure. With that, we collaborated with HKSI and many senior practitioners in the market, including Pat and Julia, who are experts in this area, to write the brochure that David talked about. It was a deep dive. It was broken down into different specific sections, how your advisors can help you, how do you put together a diverse board at CG ESG, what is the role of headhunters, and what are the policies, what do you need to do before you even think about IPOing. So that was the background. And Julia and Pat led the discussion along with it. It was a roughly 6-month project, and we had many experts. There were many discussions that went into it, hoping to come up with as practical and user-friendly practitioner insight as we could. And I think we got that in the end. And with that, I'll turn over to Pat and Julia and to talk to you a bit more about their insights and their takeaway and their highlights of the practitioner guidance that we put together. Thank you.
Thanks. So my contribution to this Corporate Governance and ESG brochure was, as well as helping with the formulation of it overall, was a chapter written on the role of outside advisors. And I had great fun because I spoke to a number of professionals who are experts in their fields to get their ideas on how they think that they, as professionals, can add value to the board of a listed company from a corporate governance and an ESG perspective. So the people I spoke to included Jay Shaw, who's the CEO of Praxonomy, which is a digital boardroom platform developed in Hong Kong. A very eminent company secretary, Irene Young, who's the secretary of CK Asset Management Holdings Limited. Arnold Ip, who runs Altus Capital, a financial services company. Patricia Dwyer, founder and director of the Purpose Business, which advises on ESG. And Jareen Tam, who is a director at the Hong Kong Quality Assurance Agency, which is a green accreditation agency, as well as Sean Lamb, senior MD at FTI Consulting, which amongst other things advises on internal controls, which, as Pat also mentioned, the big four accounting firms clearly do as well. And these people gave us their insights as to how they think that they as professionals can contribute to strengthening listed companies' corporate governance and ESG structures and profiles. So clearly the board of a listing applicant, as Pat's mentioned at the time when and Catherine have mentioned, at the time when the company lists, they have to make sure that they've already embedded the structures for good corporate governance, perhaps diversity of the board, the whole ESG structures as to how they're going to manage, set their objectives, meet objectives and so on, and report on their ESG policies. And if they have an expert team of external advisors, then they could potentially support the ListCo on an ongoing basis with this. And these professionals who I spoke to all had their own ideas, and it really wasn't an exhaustive list because, for example, PR consultants may be extremely important in putting the message across to the market, which is very important because I think these companies have to buy into corporate governance and ESG, not only because the listing rules require it, but also because it should make good business sense. There should be more investors who are willing to invest in well-run companies with good corporate governance and ESG policies. And I think that should be more and more evident over time as investors themselves become more aware and are more educated in this space. So I'll talk about some of these advisors and summarize their ideas about what they thought. So Jay Shaw was very keen, of course, on his digital boardroom, which he pointed out can streamline workflows. It's a virtual cloud-based boardroom, which has been particularly useful during COVID. And it can improve efficiency and accountability and compliance, which all contribute to good corporate governance. And it can help companies to make sure that they're adopting good corporate governance and ESG policies and structures because it facilitates the timely production of board and committee papers, orderly keeping of agenda, minutes, agreements, follow-up, and of course it's paperless, which is green in the first place. And it seems that it's not just during the COVID pandemic that this is going to be popular. It does seem that there's been a lot more buy-in for this to continue on an ongoing basis. And I didn't actually include it in the chapter, but on the base talking about tech solutions, there's actually a company out of Singapore which has got a series of question and answers which you can input into this to help companies to design their ESG reporting structures and actually to report on them. And I think that kind of solution will continue. And the more data those kind of companies have, they can also help companies to benchmark against others of a similar size or others in their industry, which is also very useful, particularly for smaller companies that really don't have a whole department who's going to be dealing with ESG. So the company secretary, well, you might not think of them as being terribly important in relation to ESG, although you would think of them in relation to corporate governance. And clearly, whilst they would benefit from the use of a digital boardroom platform, they're also important players in their own right because they provide ongoing support to the board, ensuring regulatory compliance. And they should be creating and managing effective systems within a listed company, which will definitely help the company as well with investor and shareholder communications. Irene Young of CK Asset Management gave me a wonderful quote about the role of a company secretary and their importance. She said that a company secretary is not a figure a board of directors would usually flash and show to other people, but when something goes wrong, a good company secretary can save the day by demonstrating that a sound and vigorously followed control mechanism is in place. And of course, that is the ideal for every listed company. And every listed company has to have a qualified company secretary under Main Board Rule 3.28. So clearly they have a vital role to play in the overall governance structure. And whilst the traditional role of a company secretary has evolved over time in response to more regulatory and stakeholder demands, it doesn't mean that the old role is no longer valid, but it's more that it's been expanded into other things. For example, a company secretary still has all the traditional roles of helping with corporate governance, organizing meetings and so on, but they also have added responsibilities in areas such as know your client, anti-money laundering, which all go towards good governance, and also ESG. And I think this expanded role of a company secretary also requires a shift in the mindset of the board. It requires the board to see the company secretary, and Irene pointed this out, not only as a cost center, but also have the mindset that a company secretary is really adding value to the listed company and its stakeholders through their secretary's active role in supporting the board, facilitating shareholder and investor communications, ensuring systems are in place, regulatory compliance support, and of course, professional development of the directors. Working alongside a company secretary, compliance advisors can also support the listed company by advising on announcements, connected transactions, and so on, but also in ensuring that corporate governance and ESG systems are in place. And perhaps up to now, that hasn't been something which compliance advisors have spent a lot of time focusing on. Perhaps in some cases they've been more reactive, but clearly they can play a large role in that and supporting a board on that. And Arnold Ip of Altus thinks that compliance advisors are really quite well equipped to help the board with its corporate governance structures and policies, but to maximize the value they have really depends on the relationship between the compliance advisor and the board of the listed company. So the board has to have at the outset a mindset that they're going to meaningfully engage with the compliance advisor and have an iterative discussion with them about corporate governance and ESG. And they can't just consider this as a financial burden, but rather like the company secretary, they should be viewed as people who are adding value to the board and adding value to the company. And clearly a compliance advisor can assist with decision making as long as they remain actively engaged and they're not just consulted when there's a problem which comes up and so on. So other professionals, and I don't think I have time to mention all of them, of course, would be an internal control consultant. And they can be very important. And you might think, well, a company uses an internal control consultant, they have reports done when they list, but what shouldn't be overlooked by the board is that they need to be mindful of the ongoing internal control situation of the company. And that can really be developed and built upon post-listing. And it shouldn't be something which just happens once at the time of listing. So companies can develop their structures and they can make internal controls more effective, and they can make sure that they embed the expectations in relation to corporate governance and ESG governance. Clearly, they have to, and ListCo should be making sure that they maintain risk management and internal control systems and review them annually. And they don't always have to have an external consultant to do that, but one which comes in from time to time and comes with the latest thinking and refining these internal systems and processes, which include corporate governance and ESG, can be extremely helpful. And it's also important to undergo ongoing risk assessments, which can help a listed company to identify shortcomings or gaps in their corporate governance and ESG frameworks. And this really should assist a company in their dialogue with their shareholders and their investors and meet their expectations about how much a company is doing to make sure that it does have effective ESG systems to actually enhance the value of the company. Very briefly, I won't go into the roles of solicitors, which as a solicitor, of course, I think are terribly important. And they can include, of course, reviewing, but also helping to design structures as well and giving input on compliance, not only by the letter compliance with the corporate governance guide and the listing rules and so on, but also making sure it works for the particular company if they have a close relationship with that company. And of course, they can also support a company giving timely, updated information and training to the board to make sure it's practical, because if they really know the company and its issues and they're familiar with the latest thinking on the rules, that can be of perhaps greater use sometimes than simply using external training, which is not suited particularly to the situation of a particular company. There's also the quality assurance consultants like HKEX, which give accreditation as to whether an investment product is green, which can be very important as to whether or not it could qualify as a green bond or whether certain investors will invest in it. And for ongoing financing, that type of accreditation agency can be very important. And lastly, I'll just mention that the Hong Kong Exchange has set up Stage, which is an investment. It's a green platform, which is not, it's not an actual exchange in and of itself, but it will include information about products which are listed on the exchange, which have got green accreditation and which are suitable for green investment. And that's relatively new on the exchange, but the idea is that that will build up and encourage the investors to look at the green products listed on the exchange, which will build up not only investor bases for those products, but also the profile of the exchange itself. And just for one very last point, I think it's really interesting as to what the exchange's own strategy is, because don't forget the exchange is a company which is listed on itself. So I wonder if they're considering the sort of companies they list and whether actually those companies have got proper ESG and corporate governance controls in place as part of the business of the exchange as a whole. So I think Catherine is now going to give a more holistic overview of what we were thinking about in the brochure.
Thank you. I think we can all feel Julia's enthusiasm and Pat's expertise. I think I will then, this is my kind of brief discussion on, where we're going with TCFD and ESG policy. I think we will leave the last 15, 20 minutes to the more interesting part, to see whether the audience has any questions, or if not, we can have a discussion kind of amongst three of us, a more interactive section about that. Julia, question to you. I love the digital platform that you mentioned earlier, and I can see how it would add a lot of value to listed issuers, company secretaries. I just want to hear your view on how does it strike a balance? Because some of the digital platforms I've seen, as smart as they can be, they are, some of them are a bit more like a information repository, making sure the sign-off are gotten and consolidated information. There's nothing that could substitute a board discussion. How does the digital boardroom platform complement a board discussion?
Sure. Well, I guess, I'm not particularly advocating one digital boardroom over another. I think many have good features, but I think there's some which, particularly during COVID, have advanced their technology, and they either have their own online communication platform, or they actually integrate with Zoom or another platform which the board commonly uses. So that I think at its best, it just supports proper discussion, which of course may well be online discussion. And it makes sure that directors, wherever they are, get papers and board papers on a timely basis. They have there's facilities within the boardrooms to ask questions ahead of the board meeting as well as at the board meeting, and for follow-up to be monitored and so on, and for all these board papers to continue to be available in a safe and secure environment after, long after, so people can look back at what were the agreed minutes, plenty of time wherever people are in the world, depending on the situation, to actually be able to look at everything and monitor it. So clearly, I don't think there's a substitute for actual discussion. And that's what a meeting is all about, isn't it? It's about a discussion and a meeting of the minds, at least by a majority of a board. And it's simply to support that and create an environment to allow that to happen. So companies no longer say, well, we couldn't get together for a meeting because nobody was here, or somebody was ill, or there was in this unexpected age of pandemic, everybody could still have meetings and be fully supported and make sure that everyone is looking at the same papers on a timely basis, and that follow-up is able to be done on a timely basis. And clearly that's incredibly important for ESG and corporate governance reporting, as well as many other functions of the board, like, for example, looking at the accounts and finance and so on.
Julia, so if these companies, kind of big or small, wants to get a good rating, and the first thing that they have to do is to have a ESG compliance structure, how do you advise them to go from nothing? What is the first couple steps, and maybe how, for a smaller company, they just have company secretaries, they're looking after all the disclosure. Where do they start, do you think?
Well, ultimately the board of the listed company are the people responsible for the company's ESG strategy and compliance. So they really have to take the initiative in the design and implementation of their ESG structure. And I do think that the Hong Kong exchanges was ahead of its time in some ways. I mean, perhaps not internationally, but certainly in Asia, with really setting out quite a lot of requirements which enabled a board to look at and say, well, here's a structure that we can be following. And they need to do that. And they could, of course, use ESG consultants to do that. Those were some of the people I also talked to in the guide that we produced together, that chapter where we talked about people who would actually come in and help design an ESG structure. But I still think that companies, and some of them I work with, have actually set up their own And that there's always this problem, as you mentioned earlier, with this sort of tick box mentality that, oh, I need to do this to comply. And I think there's some reports from about 3 years ago which indicate that Hong Kong has a particularly low buy-in rate of people who really do this from their hearts and really put a lot of energy into it rather than trying to do it to comply. But I do think that that will change. And really, it's only partially the role of regulators to drive this. I think regulators can set structures like the Hong Kong Exchange has definitely done, very admirably. But I think ultimately Pat's right. It also has to come from the market as well. And I think it's really important that companies see the value and they promote the value. So it's no good a company adopting this, even with the benefit of ESG consultants. They also need to get the message out. It needs to be part of their branding, needs to be in their annual reports, their chairman's reports, and so on, the importance of this. And Pat is clearly right that this is mainly an institutional investor area, that institutional investors often have funds which are set up as perhaps green funds, or certainly they want a certain proportion of what they invest in to be sustainable companies and so on. But I think it will increasingly move to retail, and that also involves investor education as much as anything, but also Generation X and Generation Z, they're going to be way more conscious. They want to buy, environmentally friendly beauty products, sustainable products, and so on. And that becomes a real selling point for companies. And I think the London Exchange actually has a whole series of companies, like a sort of board within a board which have G for green in front of them. And those share prices of those companies have done well because investors can be assured that to a certain level, that those companies are fairly environmentally friendly, they have sustainable policies and so on. So I do think to really drive this, it needs to be a market feature as well. And I mean, other aspects of this are that I'm not a US lawyer, people could correct me if I'm wrong, but I don't think the US regulators actually have a lot of mandatory provisions. It's driven by market demands in the US for US listed companies, and also litigation risk. If you don't disclose and have effective structures, for example, we heard a lot about the TCFD and so on for these climate related risks. For example, in the insurance industry, that might be massive if companies are not really disclosing that and dealing with it. So that also becomes a commercial driver for companies. And obviously, the whole setting up of Stage as part of the exchange, one would hope that that's going to increasingly drive the consciousness of the importance of having green and sustainable accreditation and policies to get better pricing on investment products and drive investor interest.
Okay, thank you. There's one question that came in through the chat. I think I'll just answer. It's probably more for me. I'll just talk about it very quickly. I think someone's asked, there's been lots of talk about improving value through better ESG, but less on regulatory impact assessment. And how, I think it just goes fundamentally. I just want to explain quickly how Hong Kong Stock Exchange at least go through changing regulation or tightening or upgrading, tightening or relaxing regulation for that matter. We go through a long consultation process. It's not something that it gets put in place because the stock exchange or certain segment thinks it's a good idea. Every rule change requires a public consultation. We take in all responses. We analyze all responses, and it's not a polling game. It's not that you have one particular group of people write in kind of 1,000 letters, you will win. So it's not like that. But we do look at the substance and the strength of each argument before we decide on the journey that goes ahead. We also look at international developments. Hong Kong Stock Exchange, we are an IFC. We are looking for international listing. We no longer just play in the little local market. We want to see what our peer groups are doing and what best practices are. So again, that is another benchmark that we look at before we decide on different regulations. There's a question, maybe Pat or Julie can answer. How human rights and labor relations on mainland, how is it being reported? Any takers on this?
Well, I think that, I mean, ultimately in that social, the social KPIs has been uplifted to comply explain in the latest round of upgrade by the Hong Kong Stock Exchange. So, I think the first reports to have that requirement will be coming out on 30th of June 2021, where you will have these labor relation aspects included in there. And I think that, that's quite a mature space in the sense of kind of like supply chain and, whether there's child labor, whether they're doing excessive overtime and kind of like occupational health and safety. Those kind of things are very, very established. I'm going to skip on the other part of that because I think that it depends on where you are in the world and what human rights mean to you. I think that, that's dependent on what that company wants to disclose from that perspective or what it means to that company. But I just want to also go back on to that previous question about the impact assessment. But I think that, beyond the Hong Kong Stock Exchange, the SFC has just completed a consultation on the climate-related disclosures for asset managers. So that just completed, I think it was 1.5 weeks ago, the consultation, or 2 weeks ago. And it is under review. But I think that, I think that a lot of the participants in the asset management industry do feel that there is difficulties in doing it. But having said that, I think that, ultimately, that's the way the world is going. And I think that the data and the consistency of information is going to improve over time. And I think that, it is something that is coming for the asset management industry. It's just a matter of time.
Thank you. With that, we've answered all. Yeah,
just jumping quickly there, Catherine, I would mention that in Appendix 27 of the listing rules, it actually specifically requires general disclosure on information on policies, compliance with relevant laws and regulations that have a significant effect on the issue relating to child and forced labour, description of measures to review employment practices to avoid child and forced labour. So, I mean, the exchange itself has tried to address that. And I would recollect that while I was on the listing committee, that I do recall that we did have some, we did look at factories when we saw companies where we thought, gosh, that might be an issue. And we did think about that quite carefully. And we often went back and asked for more information and risk disclosure. So this certainly isn't something which the Hong Kong Exchange, even in my own experience, has been overlooking, although clearly there's a lot of wider issues here.
So with that, I'll hand over back to David.
There we go. Thank you. I'd like to thank Catherine, Pat, and Julia for their insights. It's been, I think, a terrific webinar. This is clearly an area of increasing importance, and I think it's great to see the exchange putting focus on this and taking the initiative. I think engagement with the market and with industry experts is going to be key as this develops and goes forward. And also the idea of providing practical guidance, I think, is going to be critical to make sure the market understands what's going on and we move away from what has historically been a box-ticking exercise. And I was very pleased to hear Pat and then a little bit from Julia say that the market seems to be moving away from box-ticking into a substantive analysis, which I think is going to be important as this develops. So with that, I will close the webinar. Thank you to our panelists. Thank you to our audience, and wish you a good evening and hope to see you on another BritCham webinar in the future. Thank you very much.